Well, to be a master at trading, you first need to be the master of that mental game. Today, we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, today we'll meet with Steven Goldstein, one of the leading coaches in the financial markets industry and an expert on trading. Hey, Steven, welcome to Prudent Money.
Oh, pleasure to be with you.
You're an author of a book, Mastering the Mental Game of Trading, and you're here to tell us how to be better traders and investors. You know, trading and investing is a mental game, because on your way to learning, there is a tendency to make a lot of mistakes. Talk about what the reader will gain from reading your book.
Right. Okay. So, for me, it's a book that fills a gap between many other great books in this sort of sphere of trading behavior, trading psychology, trading mindset. I was a professional trader for 25 years, working at some of the biggest investment banks in the world. I had my struggles. I had many struggles. And those struggles were normally within me. Although I didn't realize that at the time, I always thought they were out there, and I just needed to find an answer out there. I needed to find the perfect system or the perfect method or the perfect analytical technique or the best research. And all of those things, they were all available all the time. The one thing I never had was the ability, at least in the first half of my career, the ability to apply myself effectively as a risk taker, as a trader, as a manager of risk. So whilst I'm looking out there, all the answers were within me. And when I eventually came to realize that and started working on that, amazing things started to happen.
It's funny, Steven, I can totally relate to what you're talking about, because I do managed money. And it's like one of these things, and I hope the audience can understand this, is that you're trying to build the perfect model to where you don't have to make the right decisions. You can make a decision, and no matter what you're covered, you've been able to get rid of all the risk. And of course, nothing like that exists. I mean, it's just such an emotional game. Talk about some of the behaviors that traders face. I'm a coach as well. So after I left trading, I decided to develop myself as a coach, thinking there would be a prescriptive approach to helping traders become better. But there isn't a prescriptive approach. There is not a one-size-fits-all. But I think if I was to look at, one thing every trader does is they become outcome-focused when they go wrong. And it doesn't matter how successful you are, how brilliant you are, how many years you've been doing this. We all face that risk of becoming an outcome-focused individual, of wanting the outcome we want and targeting that rather than staying with the process, rather than trusting the process, rather than understanding that it's the process delivers the results, rather than focusing on the results. Where if you focus on the results, you'll often, at some point, conflict your process. And there's many different nuances to that. And we're all familiar with it at times. But it's moving from a results-orientated way of engaging with risk and with markets to a process-orientated way, and almost like subverting the normal thinking paths. Well, you talk about in the book the performance process cycle. Now, how can traders use that to better navigate their trades and decision making?
Well, it's part of understanding how you engage with risk. Okay, so that was a framework or a model which I took from my
So when I learned to become a coach, I studied various forms of psychotherapy, and this performance process cycle model, which is what I reframed it as from the term, the rather evocative term which was used in the field of psychotherapy, which is a cycle of awareness, which was really how you engage in that battle between the external world and your internal world to try and achieve a task, and the different stages you go through and the different psychological phases you go through when you go through that. So any single process, any single decision, any single choice or action you take is a single task. Trading, has multiple tasks that are part of it, which makes one single task. And it's understanding how you are at each stage of the cycle and sort of starting to unpick it. So if I was to divide the cycle into two halves, for example, the first half of the cycle is really where you do your preparation for the trade, where you set yourself to be in the best way you can be, to be optimal in how you're going to go into a particular trade. Then you move through the analysis process and you generate ideas. And as you generate ideas, you start to think, how can I use an idea? How can I make money out of that idea? Can I make money out of that idea? And you start to, in a way, check that idea against your playbook to see if it fits, which are a set of strategies, tactics, methods that you use to try and make money. And then you go to the other half of the cycle, which is the part where you act. Okay? And when you go to the other half of the cycle, you almost become a different person. You're now, I use a tightrope analogy, which I talk about in the book, where instead of you walking on this tightrope at 3 feet off the ground, you're now walking doing the same process, but it's like you're 300 feet off the ground. Mm-hmm. And you become nervous and anxious, and your reactions, your ego comes in, your emotions are a het up, and you start responding to every little tick in the market, every little up move, every little down move, and you abandon your process at the altar of trying to get the result you want, rather than let the process play out. And you do things which afterwards you were like, why did I do that? Who was I? Who was that person who did that? Because that wasn't what I intended to do. And then you have to deal with the aftermath of that, which is the final part of the second half of the cycle, the part that I call the letting go phase. You have to clear your head from that. Otherwise you turn in on yourself and you start short-circuiting this very powerful, capable process cycle that becomes like a navigational aid for how you engage with the markets every single time. And if you follow it, it's an optimal cycle, an optimal way to navigate the markets. But when you short-circuit it, you go onto this suboptimal cycle where you're just constantly caught in a results, outcome, act, outcome, results, outcome, act, outcome. And you're no longer following your process, but the market is actually making you act out the way it wants you to act out. And you're not trading the way you want to trade. Ideally, you're working in a suboptimal way. And that's how we get into what we call these death spirals, where, you're just giving money away to the rest of the market.
Yeah, the trader's death spiral doesn't sound like a good place to be. Appropriately named, I will say that, appropriately named. The name of Steven's book is Mastering the Mental Game of Trading. Yeah, I want to get your opinion on this, Steven, and of course you do a lot of coaching. And for the average buy and hold investor, and as you know, there's great times to be in the market and there's not so great. Everything cycles. I've always been under the opinion that if the average investor could learn just a couple of strategies, that they could come up with a way to be defensive, that they'd be so much further ahead at their end goals than if they just rode the roller coaster. What's your thoughts on that?
Well, buy and hold has worked brilliantly for decades. But of course, it goes through periods where it's not working so well and where, it underperforms for a while. And you start to think, I want a result. I need to anticipate that. So you don't let it happen. And vast amounts of money are made from interfering with that process. Now, of course, you have to try and be optimal on the process. You have to manage what it is you've got in that portfolio. Not everything's going to be a great pick. But the process of buy and hold has just been proven to work over time. So it's the interfering with it too much. Of course, you need to interfere from time to time. You need to reappraise the basket of stocks you've got in there. So if you get ahead of it, if it fits your process, if all along you have a practice where maybe every month or every 3 months you're going to revise that basket with a tried and trusted method, that's okay. It's where you start over curve fitting it. When I talked about outcome focus, it's like curve fitting. Okay, that's losing money, so I'm going to get rid of it. Is that the best thing to do? What was your plan what was your intention when you bought that stock maybe 3 months ago, 6 months ago, 2 years ago? Was the intention for it to hold it for 10 years? Has anything materially changed other than the price? Is the story still good? Okay. Has there been something at the company that's really changed? Or is it just a couple of years of, market noise? So it's that bit where you interfere with your process. Now, I tend not to do a lot of work with buy and hold investors. I do with some, but I work with some individuals who perhaps more a better description of them might be long only fund managers.
Right.
And it's when they start tinkering with their process that they give money back, that they underperform. What one individual recently, he's had an incredible process for many years, but he suddenly, he had a load of new investor money came into him, and he thought he needs to start showing some short-term rewards, short-term results for those new investors. Now, straight away in there, you have a results focus, not a process focus. He's immediately adjusted the way he works to try and get a result, rather than trusting his process, which has worked for him for 2 decades. Okay, and that's an example of that. And as soon as he became aware that he was doing that, we discussed it. I've been an idiot with his words, but he readjusted back to this longer term focus. And the crazy thing was that none of the investors would have cared. He's got a great track record. They know how he works. They gave him the money because they know how he works, not because they were after short-term results. But it was an ego thing, which I talk about in the book quite often, of wanting to satisfy yourself that you're going to satisfy them.
Talk a little bit about biases, specific biases that traders commonly face, and talk a little bit about how that can really drastically negatively affect your results.
Okay, so first of all, we all have biases. It's part of the human condition. It's how we function. It's how we roll. It's how we've evolved and managed to, to get to where we are today. It's part of life in the, I suppose you would say, in the pre-civilized world. But it serves a purpose. Every sort of high-functioning animal has them as well. You see it in monkeys. You even see it in hunters. They don't want to get injured, so they won't attack an animal that can injure them. They'll back off because they need to stay in the game. One injury, it can take them out. So that's kind of loss aversion. That's a loss-averse approach. The danger of the injury is far greater than the danger of not having the injury. Okay? So we have those natural biases within us. The danger is that the thing is that they're not made for this world of trading. Okay, we haven't evolved to be traders. So we have to bring in some sort of ways of behaving, ways of counteracting these biases within the systems we use, the rules we use, that can actually help them not cause as much damage. It is almost a way to look at it. So loss aversion is one of those. When I work with people, I show them, it's not in the book, but a performance graph of a theoretical trader over 10 years. And this trader has a really good system or approach or method that over time has a positive expectancy and produces a great outcome. He moves from bottom left on the scale over 10 years to top right as far as P&L goes and return. But within that, there's long periods where his system or his method is underperforming. And his loss aversion is going to make him feel really emotionally challenged when he's underperforming. Okay? And he'll want to change something about what he's doing. He'll want to adjust his process. Remember, it's the process that delivers. But the successful individual won't. They'll put controls in place that stop them, that hold them back from doing that. And eventually the method or system kicks back in, and eventually it makes money. Okay? And that's the bit. The loss aversion makes us feel twice as bad when you have a negative day as you do how you feel good when you have a positive day. So it's bringing some sort of structure in how you work, not to be phased or even to keep on a positive response, a process-orientated response within that. And we have, that there's hundreds of biases. We all fall victim to them at time. We all look for data, we curve fit, we look for data which fits our prejudices, confirmation bias. So another thing that traders are encouraged to do is to work against their confirmation bias, to try and find the opposite argument because they're going to overweight a particular argument when they're looking to pick stocks so that they can try and become more objective about what they're looking at and not fall in love with a narrative or a story that's swaying their opinion. And another one is perhaps holding on too long. When this is perhaps for more shorter term investors, but when the story that you've got plays out, people then just hold on to the stock because they've fallen in love with it because it's been good to them. We call this the endowment effect, which is another bias. But actually, the story's played out now. Okay, there is no reason why that stock should perform better. And I'm not talking about buy and hold ones, but I'm talking about particular setups and strategies at that point. And quite often it's been shown through research that the further you get away from the point of the setup or the story for that stock, the more likely it's just going to fall backwards and underperform. But people just hold it because they've fallen in love with the stock. They're no longer holding it for the right reason. They're holding it again because of their bias.
Stephen, I think that just looking through some of these emotions that have negative effects, the one that jumps out at me is trying to avoid failure. That's got to be ranked very high up on the list, I would think.
Oh yeah. I wouldn't so much call that as a bias, as an ego behavior. That's a kind of loss aversion. So you said that trying to avoid failure, you're averse to losing money. It's the same thing, just framed differently.
Right.
Okay. We're all wired that way. We all want a great outcome. We all want to be our own heroes in our own story. We all want the world to look at us as geniuses. No one on planet Earth has been born yet who in some way doesn't think like that. That's how the ego functions. But again, in trading, it's not necessarily helpful. So you try and have a process, and failure is within that process. There will be some people who have a fantastic success rate over many years in trading, but actually have a very low win rate, sort of single figures, single digit figures. But they have a fantastic risk management process around that. So they get out of their losses very quickly and they stay with the winners because, those seem to be gathering momentum. So I think it was Jim Rogers who said, a lot of people get this the wrong way around. They take their profits quickly and allow their losses to run, which he said is like cutting the heads off the flowers and allowing the weeds to grow. It's this lack of process or lack of understanding of how we are, of how markets work, and how the two come together. And this is really what the book's trying to tackle, trying to raise awareness of, trying to bring people to understand. Again, using stories, using real narratives from my own story, from other people's stories, people that I've coached, people that I know, and just sort of adding flesh onto the bones of the theories that I'm talking about.
So, Steven, I've got about a minute or so left. What was the biggest obstacle for you to overcome as a trader?
Thinking analysis was the answer. So I wasn't a risk taker I thought I was. I was considered for the first half of my career, I was an analyst who thought the answer for trading was in the analysis, when it wasn't. You have to be able to monetize that analysis, and that's about becoming a risk taker. And only about halfway through my career, when I started to become a risk taker, where I started making more money. I started engaging more healthily with risk and uncertainty.
Once again, the name of Steven's book is Mastering the Mental Game of Trading, Harnessing the Power of the Inner Self for Fuel Toward Outperformance. Steven, thank you so much for coming on the program today. I know this is going to help a lot of people.
Brilliant. It's been a pleasure, and good luck to you and to the show.
Thank you. Good luck to you. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. I have seen this so many different times, even battled with it myself, and it's the control of the emotions that go into investing and trading. I would say that you could look at your roadblocks, the things that get you into trouble while you trade. I didn't get a chance to ask Steven this, but there was a gentleman that I knew that was a trader, and he described it as an addiction. And it had every quality of an addiction as well as he was talking through it. But without question, it is a mental game. And until you get that taken care of, I don't care how good you are at trading, it catches up with you. You can get more information. Go check out his book, Mastering the Mental Game of Trading. And I bet you if you are trading investments that you might find a few things in here that you might be doing that you want to change. Hey, this is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.